Namaste, welcome to Arthaniti. Tax season is just around the corner. Instead of hiding our income and evading tax, making use of all possible tax saving options is the smartest thing to do. After all, paying taxes is not only our legal obligation but a fundamental duty as well. But we should know all the relevant sections of the Income Tax Act to get maximum tax saving benefits. Right now, I want to tell you a story about my friend. She sold her old car a few months back. She wanted to buy a new one. So she went and booked the new car. But the car dealer told her that it would take a waiting period, some months before she gets her new car. Now, she is going to get her car 6-7 months from now. Why? Because that is the norm that has happened lately, that it is taking time to get delivery of new cars. Now, when she was telling me about this and how she had to wait to get the new car, I asked her what she did about the money that she got from selling her old car. Well, she said the money was not much, around 1.5 lakhs to 2 lakh of rupees, and she had kept it in her savings account. Her idea was to not take a new a new car loan and make full payment of the car using her own money. So she wanted to keep the money ready as and when she would get the delivery of the car in the future, and she could make the final payment to the dealer. That is what her idea was. So she had kept that money in her savings account. Now I asked her if she knew that the interest that she would earn on her savings would attract tax. Now, to that, she said she was of the opinion that interest on savings account was tax free. Well, this gave me the idea of this YouTube video. Now, in this video, as I explained my friend, I would divide this video into two parts. First, I would explain how interest is calculated on our savings account, and secondly, how it is taxed. Right now, let us start with the first part. How is interest calculated on savings account? Interest is calculated on our savings account on a daily basis. The balance that we maintain in our savings account is multiplied by the rate of interest that our bank is offering on saving accounts. It is normally in the range of 3 to 4%. So our balance multiplied by the rate of interest multiplied by the number of days in the month. So 30 say upon 365, that is the total number of days in a year. That is how interest would be calculated on a daily basis on the balances that we maintain in our savings account. Now, this interest is not deposited in our accounts on a daily basis, neither on a monthly basis. What RBI prescribes is that banks credit this interest that is earned on the savings account, which is calculated on a daily basis, but bank credit it to our savings accounts on a quarterly basis. Now, these are RBI guidelines. So, starting from 1st April, every quarter, at the end of every quarter, bank will credit interest which it has calculated on a daily basis in our savings account. Right? So, this is the first part. How is interest calculated? On a daily basis but credited to our savings every quarter. This interest rate ranges from 3 to 4%. Some banks do give higher interest rates, but normally it ranges between 3 to 4%. Right? Now, let us look at the second part. How is interest taxed? Savings account interest tax. Well, for individuals and HUF, Hindu Undivided Families, any interest that your savings account earns up to 10,000 rupees in a financial year is tax free. Right? So, any interest that you earn above 10,000 will be taxed. How will it be taxed? That will be shown under the heading income from other sources in your tax form, and it will be added to your other income and taxed at the tax bracket you fall in. That is how it is taxed. Now, some things that you should know. Is this for individual accounts? Say most of us have bank accounts in 2-3 banks. So is this limit for individual accounts? Well, no. This is a collective limit. So say if you have bank accounts with 2-3 banks, say State Bank of India, HDFC Bank, say some other third bank, all your interests together should not exceed 10,000 rupees in a financial year. So that has to be taken into consideration. This is not per account limit, but this is a total limit of all the interest that your savings accounts, which you maintain with say more than one bank. Totally, if you are earning an interest which is higher than 10,000, then that interest will be taxed. Now, this limit is for whom? This limit is for individuals and HUFs. This savings account can be maintained with any public sector bank like government banks or private banks, post offices, cooperative banks, so on and so forth. So all these interests taken together should not exceed 10,000 rupees in a financial year. If it exceeds 10,000 rupees, what happens is the first 10,000 is exempt from tax, and any interest that you earn above it will be taxed. Correct? So this was as per section 80TTA. Now there is another section 80TTB. Now who does this relate to? Well, this relates to senior citizens, people above 60 years of age. Now for them the provisions are different. We'll see what the provisions are. Okay, now for senior citizens, individuals and HUF, okay, senior above 60 years of age, the limit is 50,000 rupees, but it does not relate only to savings account. It is on any interest that is earned from savings account, from fixed deposits. In total, for senior citizens, it is exempted up to 50,000 rupees. Above that, it will be taxed. Correct? So under section 80TTA for individuals and HUF, 10,000 rupees is the limit only on savings account, which with whichever bank you maintain it, that your interest will be tax free. Any interest on savings account above 10,000 rupees that you earn will be taxed. Section 80TTA. Under section 80TTB, it is for senior citizens above 60 years of age. The limit is 50,000, but not only for interest on savings, it includes interest on savings, on fixed deposits, all taken together. Correct? So this needs to be kept in mind when you are putting money, when you are keeping money in your savings account, and you are of the impression that any interest that you earn on it will be tax free. Please be advised that interest on savings is taxable beyond the limits that I have told you. Secondly, as I told you, keeping large sums of money in your savings account is going to erode that money from its purchasing power. Why? Because if you are earning at a rate which is lower than the inflation rate, obviously your purchasing capacity with that money reduces over a period of time. So you have to take into consideration as to how much money you should keep in savings, what will be taxed, what are other options wherein you can earn better and save tax. Check out for this space where I will help you understand this in my next video. I hope I have helped you understand how savings account interest is taxed and how you should think about it if you are keeping large sums of money in your savings. Any comments that you have, any questions that you have, you are free to comment below the video. I will be happy to help you. Until my next video, be safe and happy investing.